There is one decision in trading that will determine whether you survive the next 10 years. It is not which strategy you use. It is not which broker you choose. It is not which markets you trade. It is where you put your stop loss. Get this wrong and you will die by 1,000 small cuts. Get it right and you will survive long enough to compound an edge. Most retail traders place their stops the same way. They pick a number that feels comfortable, 20 pips, 50 pips. 1%. They size their position around the stop. They set the order. They walk away. Then the market does what the market always does. It runs through their stop, reverses, and goes exactly where they predicted. Without them, this is not bad luck. This is structurally guaranteed. Here is why. The market does not care what number feels comfortable to you. The market reacts to structure, prior highs, prior lows, round numbers, volume nodes, trend lines. The places where institutional money decided something matters. When you place a stop based on how much you are willing to lose, you place it in the middle of nothing. There is no structural reason for the market to respect that level, so it doesn't. It runs through it because there is nothing there. When you place a stop based on structure, you place it in a location that the market will not reach, unless the trade thesis is genuinely invalidated. The market either holds that level, and your trade works, or it breaks that level, and you exit because the setup is genuinely broken. Same loss, completely different probability of being stopped out before you are right. Here is the rule. Find the structural level that invalidates your trade thesis. Place your stop one tick beyond that level. Then size your position so that the distance from entry to stop equals the maximum loss you are willing to accept. Do not flip this order. Most traders pick the position size first and then place the stop where the size dictates. That puts the stop in the middle of nothing and asks the market to respect it. The market will not. There are 3 categories of structural stop placement. First category: below a recent swing low for longs, above a recent swing high for shorts. This is the most common and the most reliable. The swing low or high is the level the market most recently respected. If price breaks it, the immediate context that gave you the trade is broken. Second category: below or above a key moving average. The 20, 50, or 200 EMA acts as dynamic support and resistance. When it aligns with a structural level, it doubles as a stop reference. Below the 50-day EMA on a longer-term hold. Below the 20-period EMA on an intraday trade. Third category: the other side of a Fibonacci level, a measured move target, or a volume node. These are the, if the market goes here, my whole framework is wrong, stops. They are wider, but they are surgical. When price hits them, you know the trade is genuinely dead. Common mistakes to avoid: do not place stops at round numbers. Round numbers are the stop hunter's holiday. 20,000 on the Dow, 10,000 on the Nasdaq, 20,500 on the FTSE. The market will run these levels deliberately to clear stops. Place yours 1 to 2 ticks beyond the round number, not at it. Do not place stops at the obvious level everyone sees. The break of a daily low, the break of a clear horizontal. Everyone is at the same place. Institutional money knows where retail stops sit. Place yours just beyond, where the obvious level breaks plus the typical run-through. Cost you a few extra points, saves you the whipsaw. Do not move stops to break even before the market gives you reason. Moving the stop to entry too early is a different way of selling too early. Wait for the market to confirm the trade is working before you tighten. Confirmation usually means a clean push past the first target. Here is the systematic process. Identify the structural level that invalidates your trade. Place the stop 1 tick beyond that level. Calculate the distance from entry to stop in points or pips. Calculate position size so that distance equals your maximum loss. Set the order, walk away. 5 steps. Decided before the trade. Mechanical execution. The traders who survive long-term are not the ones who pick the best setups. They are the ones whose stop placement gives the trade enough room to actually work, then exits cleanly when the structure is broken. Stop placement is the difference between 1,000 small cuts and 1 bad trade you learn from. Get this right and the rest of your trading improves automatically.